Another day, another story. Throughout human civilization, the development of financial systems and institutions has played a pivotal role in shaping the trajectory of societies. From ancient forms of bartering to the sophisticated global financial networks of today, the evolution of finance has been intertwined with changes in technology, politics, and economics. Understanding this historical development provides valuable insights into the foundations of our modern financial landscape. The origins of financial systems can be traced back to ancient civilizations, where early societies utilized various forms of exchange to facilitate trade. Barter systems were prevalent, allowing individuals to exchange goods and services directly. However, the limitations of bartering, such as the double coincidence of wants and the lack of a standardized value system, led to the emergence of alternative solutions. The birth of money. The introduction of money as a medium of exchange marked a significant milestone in financial history. Ancient civilizations began using various objects, such as shells, beads, and precious metals, as a means to represent value and facilitate trade. Over time, these objects evolved into standardized forms of currency, often issued and backed by powerful institutions or governments. Early financial institutions. As societies grew more complex, specialized institutions emerged to cater to the expanding financial needs. The earliest known financial institutions were temples in Mesopotamia, which acted as repositories for surplus goods and served as centers for lending and borrowing. In ancient Rome, private banks known as argentari provided financial services, including deposits, loans, and currency exchange. The birth of modern banking. The Renaissance period witnessed resurgence in banking and finance, with the establishment of early modern banking systems. In 14th century Italy, powerful merchant families, such as the Medici, played a crucial role in financing trade and providing credit. These influential banking houses created a system of bills of exchange, enabling the efficient transfer of funds across long distances. The birth of stock markets. The 17th century brought about the birth of stock markets, transforming the financial landscape. The Amsterdam Stock Exchange, established in 1602, became the world's first formal stock market, where traders could buy and sell shares of the Dutch East India Company. This innovation allowed companies to raise capital by selling ownership stakes, while investors gained opportunities to participate in the growth of businesses. Industrial Revolution and modern financial systems. The Industrial Revolution of the 18th and 19th centuries marked a period of profound transformation in financial systems. Advances in technology, such as the steam engine and mechanized production, led to increased industrialization and global trade. This era witnessed the establishment of central banks, the development of modern stock exchanges, and the emergence of new financial instruments, including bonds and derivatives. The rise of global finance. 20th century witnessed the rapid globalization of finance with establishment of the Federal Reserve System in the United States in 1913 and the Bretton Woods system after World War II laid the foundation for the modern monetary system. Advances in communication and transportation technology, such as the telegraph, telephone, and later the Internet, revolutionized the speed and efficiency of financial transactions, enabling the growth of global markets. Technology and financial innovations. In recent decades, technology has driven unprecedented changes in the financial industry. The advent of computers and the Internet paved the way for electronic banking, online trading, and the emergence of fintech startups. Cryptocurrencies, such as Bitcoin, introduced the concept of decentralized digital currencies, challenging traditional monetary systems. Financial crises and regulatory responses. Financial history has also been marred by recurring crises, such as the Great Depression of the 1930s and the global financial crisis of 2008. These crises had significant impacts on the global economy and led to widespread economic downturns. In response to these crises, regulatory measures were implemented to prevent similar events from occurring in the future. Here are some key aspects of the crises and the regulatory responses. Great Depression of the 1930s. The Great Depression was triggered by a combination of factors, including a stock market crash, excessive speculation, high levels of debt, unequal wealth distribution, and a decline in international trade. In the United States, the government implemented several measures to address the crisis, including the Glass-Steagall Act of 1933, which established a separation between commercial and investment banking to prevent conflicts of interest. The Securities Act of 1933 and the Securities Exchange Act of 1934 were enacted to regulate the securities industry and promote transparency. These regulatory changes aimed to restore confidence in the financial system and protect investors. Global financial crisis of 2008. The 2008 financial crisis was primarily triggered by the collapse of the housing market in the United States, fueled by the proliferation of subprime mortgage lending, securitization of mortgage-backed securities, and inadequate risk assessment by financial institutions. It led to a chain reaction of failures and a widespread liquidity crunch. In response to the crisis, regulatory reforms were introduced globally. The Dodd-Frank Wall Street Reform and Consumer Protection Act of 2010 in the United States aimed to increase financial stability by imposing stricter regulations on banks and other financial institutions. It established the Financial Stability Oversight Council, FSOC, to monitor systemic risks and created the Consumer Financial Protection Bureau, CFPB, to enhance consumer protection. The Basel III framework was developed to strengthen the global banking system by increasing capital requirements and improving risk management practices. These regulatory responses aimed to address the weaknesses and vulnerabilities in the financial system that contributed to the crises. They aimed to enhance transparency, improve risk management practices, strengthen oversight, and protect consumers. However, it's worth noting that the effectiveness of these regulations is a topic of ongoing debate, and financial crises can still occur due to various factors and unforeseen circumstances. Thanks for watching.